back to the channel, guys. Good to see you as always. Now, I have to film part 2 because last week's video is highly controversial. I put a video out called, "Is the 30-year loan a ripoff? Question mark, question mark, question mark. What the bank does not want you to know." Now, I never said the 30-year loan is a ripoff. I think it's a great way to create cash flow. Never said that whatsoever. Never said the bank is a scam, and I don't know why people keep thinking I said that. And I didn't even say that the bank is a ripoff until today, because the bank is a ripoff, because if you put your money in and you're getting a return of less than a percentage point on your money, that is a ripoff. Now, the difference between a ripoff and a scam is one's illegal or on the borderline of being illegal. One's just a bad deal. So it's kind of interesting that people hear one thing and spin it another way. The video was on wealth creation. If your goal is to create wealth as a real estate investor and owning real estate long term, why are you using a 30-year loan? We're gonna break down some myths. I'm gonna show you the reason why when you go to get a bank loan to own real estate, the bank does not voluntarily ever push upon a 15-year loan to you. Very rarely do you hear a mortgage broker or anyone at the bank say, "Hey, here's a really great 15-year loan. I advise you to do this. Why don't you take a look at our 15-year loan product? You should really take a look at the 15-year loan." Now, why do you think they don't do that? There's a reason. We're gonna look at the reasons on the board behind me, as well as break down a real case study, backing with facts, numbers, logic, and reason, why you should be using a 15-year loan, just like every seasoned investor does that I know that's really created wealth. Now, the reason why so many people have a 30-year loan is because it's the masses, right? The bank pushes on you. A lot of people go out there in the marketplace and get a 30-year loan. Then they go to the networking events. They say, "Oh, I got a 30-year loan. I got a 30-year loan." And then it just compounds out through a spiderweb effect. This is not the way to create wealth. Now, you have to ask yourself, what is the desired income? Cash flow today, make a little bit more today, or create wealth tomorrow? Because it's a difference in opinion, and nobody's right and nobody's wrong. But I'm gonna really break this down in detail, guys. Let's look at these numbers, because this is gonna shock you when it comes down to your career, how much more money you're gonna make if you go the wealth creation route. Now, this is a house right here. It's gonna be worth, we're gonna finance $150,000. That is gonna be the loan amount, but it's worth $200,000. So you're gonna have some equity in it. You should always have equity in the properties when you go to finance the property. Now, just a quick comparison right here. This same property, if financed on a 3.99% loan, if it was done on a 15-year loan, to go free and clear, meaning once every payment's made and you own the property free and clear, you're gonna pay the bank on a 15-year loan $49,580. Same property, same $150,000 loan, same interest rate on a 30-year loan, you're gonna pay them $107,493 on top of that $107,000. Now, that is number one. That is one of the reasons the bank does not want to push a 15-year loan on you. Look at that. That is over double the amount of money they're gonna make on the same property. Why do you think they would try to work for less? Would you work for less? Would you rather make $49,580 or $107,493 on a flip or on any transaction or any investment that you do? So if you would not want to work for less, why does the bank want to make less? That's one of the reasons why you don't see more people on a 15-year loan. It's not that they're hiding it from you. It's just that they're, well, I mean, I guess they're hiding it from me. They're just not voluntarily bringing up that this is a great option. They constantly say, "Hey, check out the interest rates on our 30-year loan," right? That's what they really want. Now, we're gonna use a comparison today, guys, for 10 houses, assuming you built a 10-house portfolio, same house, same loan, cookie cutter style, everyone's the same, to make the math easy. We're gonna assume that this property right here rents for $1,650 a month. Now let's take a look at these numbers, guys, because this is gonna be very interesting as we go through this. I know I talk quick, so I'm gonna try to slow it down for today's video, but you have to understand, guys, you need to be working on your skill sets. I spent a lot of money and a lot of time to read fast, write fast, type fast, and talk fast because I wanna hit my goals fast, okay? Now, right here, we have a 15-year loan, a 30-year loan, 3.99% across $150,000 being financed, and you have a PITI payment, principal, interest, taxes, and insurance. Now look at this. This is the second thing that the bank does not voluntarily want to bring up. Are they hiding it from you? No, but they just don't want to point it out, right? Okay, look at this. Principal on the 15-year loan for the first month is $610. Principal paid down on the 30-year loan is $217. Now this is interesting right here. Look at this. On interest paid, month one on both the 15-year loan and 30-year loan is $499. Think about that. Almost 3 times the principal being paid down year one on the 15-year loan as the 30-year loan, and interest is the exact same. Is it better for you to pay down more principal or less principal starting from day one? Think about that. What is your desired goal, especially when you're looking at equity positions with credit lines being pulled off? Now, we're going to use total PITI over here for the 15-year loan, $1,519, and over here, it's going to be a total of $1,126 for the 30-year loan. So this is the second reason they don't want you to notice what's going on with the numbers behind the scenes. Now, they're giving you a massive loan packet, not like they're scamming you, not like they're hiding it. It's given to you. People just don't read it. This is why I'm saying people need to know what they're looking at. So 1650 minus 1519, you're going to get cash flow on the 15-year loan is 131. And over here on the 30-year loan, 524. Now, this is why most investors gravitate towards a 30-year loan. They see the difference right here. It's over around $400 more in cash flow today. Now, you need to have what's called self-discipline and maturity when it comes to your business, I guess you could say. It's the difference between immediate and delayed gratification. One is broke forever, one is creating wealth for the generations to come behind them. Now, here's what some of those people comments are going to be right now. He didn't bring up vacancy and repair. Of course not. Why should I? This is not what I'm doing for this example, or hardly any of the examples. A lot of people want to bring this up. Those people, that kid in class, right? So nobody likes those people, but we're going to address this. For vacancy, guys, this is an important lesson. You should be putting in your lease agreement that you can show your property 60 days, 30 days, sometime decently in advance, that your tenant has to let you know they're moving, and with a 24-hour notice, or even a 12-hour notice, or whatever you want to put in there that they agree to, that you can show the property to future tenants. The longest I've ever had a property not rented out as far as a vacancy loss my entire career is about 40 days. Most of them I'm turning over in 10 days, a lot of times 48 hours or less. The reason why is I know their move out date and I'm showing the property before I have it rented with the next person moving in. I try to have them move out, clean the property, do the touch-ups, next person's moving in. So I really don't factor in vacancy loss, as well as I'm over rehabbing my properties for the rental market in that area, so people don't really have a choice. They love the house compared to other properties on the market at the same price point, so why would they leave? And as far as repairs, you shouldn't have a lot of repairs on your rental properties, guys. You should be fixing them up to the nines, as a saying, bring them to the top of the market. And a lot of times I'm putting brand new HVAC, new roof, I'm bringing these properties up to very, very good condition on the front end. Now, that being said, yes, you will have some of these costs from time to time, and so only having $131 a month in cash flow could be risky. That is why when it comes down to your decision, are you creating cash flow today to live off of and use for your business, or are you creating wealth tomorrow? This is a strategy for people making money already. They already have cash flow coming in from rentals or notes. They already have good active income coming in from selling real estate, flipping real estate, wholesaling real estate, other active income strategies. They have a nice job. So you have to factor all these in. But if you're not trying to create cash flow and wealth, why would you use a 30-year loan? Now, second one right here. Number two, this is one of those people's statements again. Well, this is a big myth, right? Think about this. I can take this extra $400 a month and reinvest it into my business or invest in something else and get a return on this money. Okay, you could. But the discipline it's going to take to do this is almost impossible for the average person. Very, very few people, almost nobody will ever do this. Also, how can you invest little chunks of $400 each month here and there? You need lump sums to invest, and you maybe will put this into marketing or put it in some parts of your business, but it's just highly unlikely, guys. This is very unlikely, put it that way. So you're not going to do this, you're not going to reinvest it. Now, even if you did, in comparison to doing it the way I'm saying, with getting rapid principal paydown, when that equity position is created through principal paydown and equity appreciation, when you take a credit line, because the property is accelerated down quickly, and you pull up an equity credit line from a private lender, an institution, however you're going to do it, against that property, and you cycle those giant lump sums as compared to these tiny little nuggets coming in month by month, I promise you, you're going to have a lot better return on your income, and the numbers are going to work out. So even if you did this, even if you're going to argue this, which I get it all the time, you still will make less money if you understand how a calculator works, because my calculator cannot lie to your calculator, and if you start playing with the numbers, you're going to realize I'm right. Now, the last one of those people that's going to be sitting there screaming at the screen is going to make this argument, well, what if I choose the 30-year loan that has higher cash flow today? I control everything, and if I want to accelerate and throw principal towards it every month, I can on the months I choose to. Okay, you can, but let's say you don't do it on all the months and just some of the months. That doesn't make any sense right there, does it? So the numbers still aren't going to crank out. And let's say in a perfect world you did this, which nobody's ever done in my opinion, still, it doesn't make any sense. Let's say you just did this every month, why not just get a 15-year loan? So you don't have the temptation to go spend that money at the mall on a nicer suit or nicer dress or nicer purse. You don't go get a nicer bottle of wine, a nicer dinner, because that's where this money goes. Let's be honest. The extra cash flow does not go into the principal of the property. I literally know nobody has ever done this. Probably nobody's ever done this consistently on every single payment going forward or on the majority of the payments. So why even leave yourself the temptation? I know it sounds good in the mind, but so does setting your goals here in a few days for the New Year's to get in the gym at 5 a.m. every single day before you go to work. It's good to have the idea to do something. It's a completely different back-end process to actually fulfill that idea and actually do it. It's easy to say it, hard to do it. Okay, it's a little bit of rant, but now let's dig into the numbers and look at this closely, guys. 30-year loan, using a 15-year loan in two parts. What I mean is the first 15 years, you're gonna have a loan on it. After the first 15 years, you're gonna have another 15-year period to compare it to the 30-year loan down here. We're gonna look at cash flow numbers. So the second 15-year loan, our second 15-year part of this is gonna have no loan on it because the first 15 years has paid it off. So P&I is gonna drop off. So you're just gonna have taxes and insurance. They're gonna stay constant across both loans, as well as equity is gonna stay constant, so we're not gonna look at those. So $1,650 is gonna be minus $300 for taxes, minus $110 for insurance. And the second part, so your cash flow is gonna be $1,240. So here's how the numbers work out. For the first 15-year loan part, you're gonna have $131 a month cash flow. So take 131 by 12, that's your yearly cash flow for one property. Now we're using 10 house example, so take that by 10, and you have $15,720 for 10 houses, 1 year cash flow. Now we're gonna be comparing this 30 years to 30 years with the two different loans. So take your $15,720, times it by 15 years. Now you're gonna see $235,000 and $800 on top of that for your cash flow for the first 15 years, right? There's gonna be a loan on it. Now the second 15 years to compare it to the 30-year loan, there will be no loan on it, and you're not gonna have a P&I payment. So cash flow is gonna dramatically go up, and this is what you need to realize. So you're gonna have $1,240 cash flow for the second 15 years if you go this way. Now think about it. You're gonna have $1,650, no more P&I payment, so $1,650 minus $300 minus $110 equals $1,240 cash flow a month. By 12 is a yearly cash flow by one property. By 10 is $148,800. That'd be 10 properties, 1 year cash flow. Now you're gonna have 15 years because you have the first 15 plus the second 15. I hope I'm not losing you guys, to equal out the 30-year loan in the first place. So we're comparing 30-year loan versus 30-year loan, two scenarios. Now if you take your $148,800 times 15 years, that's an extra $2,232,000 in cash flow, plus the first 15 year of $235,800 is a total cash flow of $2,467,800 if you're comparing the two parts of a 15-year loan, when there's a loan on it and when there's no loan on it, to get 30 years total if that's the way you go, okay? Now, we're gonna compare it to if you just went with a traditional 30-year loan in the first place. Right here, 30-year loan, your total cash flow right here is $524 a month. 524 by 12 creates a 1 year cash flow per one property, times 10 equates out to $62,880. So that would be 10 properties for 1 year's cash flow. Now take your $62,880 by 30 years equals $1,886,400 in total cash flow if you took 10 properties, financed at the same interest rate, the same amount over a 30-year period as compared to up here, same interest rate, same financed amount, but on a 15-year loan. These are how the numbers crank out. Look at the difference. Subtract this from this, $581,400 more. That's a lot of money. So think about that when you want your extra cash flow today versus what you get tomorrow. It takes a little discipline, guys, but what is your desired end game? What is your desired goal? Now, I also want to point out a third reason why the banks do not want to push the 15-year loan. Because rapid principal pay down. They know from time to time people are going to change and do things with their business, and they may want to pull and refinance out and pull some equity out. But what if you have a massive pay down over 7 years and you decide to refinance and you can pull out 80 grand or whatever it is? But what if you don't need 80 grand and you just want to pull out 30 grand? You're going to refinance down into a lower rate, dropping this payment, so you're not going to refinance as much, and so it's just going to be not as beneficial for them. So long story short, I know it's a lot of numbers, guys. Good thing it's a video because you can rewind it, watch it again. You need to understand, you're not going to reinvest this cash flow. You're going to spend it somewhere else. We know how history works. You're not going to throw it towards principal. And when it comes down to this, the bank is not hiding these things and the bank is not ripping you off. The numbers are all out there. You just don't look at them, just like someone doesn't look at a contract when you offer it to them. But when it comes down to it, when it comes to looking at wealth creation, the 15-year loan is better. This is why seasoned investors are doing this. Guys, I hope you liked today's video, and I hope this kind of broke it down. So if you have a bunch of 30-year loans, great. Not saying it's a bad thing. Hope you don't think I was saying that. Now, subscribe to the channel if you like this. Hit that notification bell as well. Hit the thumbs up button, guys, and I'll see you on the next video. Have a good day.